All right, so good evening, everyone. All right, so this is our fourth session. We're going to look at a few things. So we'll do a quick recap. I know we didn't have actual notes on the deferred tax. So I actually sent you those notes for the ETC. I actually also sent you that for the employment tax credit, because even though we started the workings, you didn't have the notes, but we went through the slides. So I think that should be helpful. All right, let me just bring up the deferred tax notes. I will go through the deferred tax notes quickly. We have two cases I want us to do. First one a little simpler than the second, and I also sent you an income tax, a template you can use to calculate income tax for companies. All right, so that's pretty much what our focus is going to be on. Today, we're going to look through that template as well. Let me just bring up the deferred tax notes. Second here.
Hello?
Yes. Y'all not hearing? Okay, I'm assuming that you're hearing. Okay. Hopefully you are. All right, so I just the one that have a Jamaican tax adapted. So it's two of them. One of them has more IFRS generally, and then this one a slight adaptation to it. So I'll just open that one. I'll just go through that one. Disconnect and come back again, Karen, because if you're not the only one, then maybe you just need to disconnect and oh, you're not going to hear me. So I'll just type it. So disconnect and rejoin. All right, let me see. My audio is, yeah, same as system, same as system. Okay, so that should be fine. All right, share screen. All right, so deferred tax, as we said from our first session, is that it basically arises when there's a temporary difference, meaning the value you have on the books is a different value that the government has. The government value is based on the capital allowances applied to the asset. Your value is based on depreciation applied to the asset. Now, generally, our income tax rate is 25%, but for regulated entities, it's 33 and a third percent. Now, deferred tax basically must be calculated using the tax rate.
So I don't know how to do the other way side.
Yeah, when you're joining, you don't join. Oh, the initial. Okay. All right. So the tax base under the Jamaican Act. So tax base basically reflects the allowable or taxable under the Income Tax Act, meaning capital allowances. Looking at the capital allowances, disallowed expenses, and the loss relief rules. So then we notice all of those things would basically be what's on the balance sheet. All right, so we're going to be looking at those. So what's a deferred, how we look at the deferred tax liability. Now, the deferred tax liability, it arises when taxable profit is lower now, but will be higher in the future. And we'll see what that means. So it's lower now, but it will be higher in the future. What would be the causes for that? The capital allowance rate higher than your depreciation rate, right? So the capital allowance rate higher than your depreciation rate. That is the case, you may end up with a deferred tax liability. Okay, and of course, the reverse would be an asset. Secondly, asset revaluation. So it's not taxed until the disposal. So even though you revalue it in your books, the tax doesn't apply until you actually sell the asset, until you actually dispose of it. And that's why it's called deferred tax. I mean, it's not going to arise until more than like liquidation, right? The third one is accelerated wear and tear allowances. For example, the whole new thing we're saying about capital allowance, buildings done in 25, 26. So that accelerated capital allowance, that also could be something that will have some deferred tax implications. Well, will have deferred tax implications. So an example, capital allowance, the cost of the equipment, $1 million. Your accounting depreciation is 200,000, but your capital allowance is 300,000. The tax rate is 25%, then it means what you have on the balance sheet is 800,000 in your books, right? So on your SOFP, 800,000. But the tax base, when you look at the capital allowance schedule, the written down value, 700,000. So there's a difference between the two values of 100,000. Now, because there's a difference, you're going to apply the applicable tax rate, which in most cases is 25%. So 25% of the difference give you a deferred tax liability of $25,000. How do you account for it in your books? You're going to debit the income tax expense, not the liability, but the income tax expense that's in the P&L, the income statement, and credit the deferred tax liability. For deferred tax asset, that arises when the taxable profit is higher now, but you're going to be lower in the future. And you recognize it again only if future taxable profits are probable. Now, this must be highlighted. You only recognize a deferred tax asset in your balance sheet when you believe you're going to make profit in the future. If you realize that this company is going down, there's no profit to make, you cannot recognize that deferred tax asset. You should not. Because the whole objective is you're going to recover it, offset it against something. If you don't expect profit, then there's not going to be anything to offset it against. So you're wasting your time, right? So there's no need to account for it. So the deferred tax asset should only be accounted for if you believe that you're going to have profit in the future, right? So common causes are going to have with that, again, provisions that are disallowed for tax until it is paid, tax losses that are carried forward, accrued expenses, but they are not deductible until they're actually paid. So an example, provision. So you make a provision for 120,000, whether it be accrual provision, whatever you want to call it. But tax deduction is allowed only when it is paid. So that means you have a complete difference between 120,000 in your books and the taxman say it's zero, but the taxman don't allow it at all, right? So you have that liability, that provision of 120. Taxman says zero, so you have a difference of 120,000, right? Now, because it's on the liability side and that excess is there, it's going to be a deferred tax asset, which is going to be 25% of the difference being 120,000. Again, the reason why the difference is 120 is because in the books you have 120 and the taxman says zero. So the difference between 120 and zero, 120. Cool? The journal that is done, and you only do the journal if you expect to make profit in the future, is debit deferred tax asset, credit the income tax expense. Now, the third and final main thing is tax losses. Loss relief rule. So losses may be carried forward indefinitely, right? So locally, here, our tax laws that can carry forward the losses indefinitely. And this is from 2014 up, right? You cannot carry back. So you can't look, you never filed 2022 and you made a loss in 24, but now you filed 22, 23, 24, you're going to carry it. No, you can't do that, right? So you only can carry forward, right? So losses can only be carried forward indefinitely. The only limitation is the 50% rule, meaning that the losses that you can offset against the current year cannot exceed 50% of the chargeable income for that year. So it cannot. However, if it is a new company that was formed within the first 5 years, the 50% limit is not applied, right? And also, if it is a small company that is below the GCT annual threshold, then that 50% rule does not apply, right? We say that because we might be doing small companies, yes. Within 0 to 5, the 50% limit, the cap, you can write off everything. The cap doesn't apply. Because most of the time, companies are loss makers within those years. So recognize you can actually write off everything. There's no cap, right? Similarly, if it is a company that is small entity below the GC3 threshold, then all right, them now get revenue, their revenue is already below that, then yes, the 50% cap does not apply as well. Cool? That's the only restriction. But generally, indefinitely, offset only against income from the same source. Yes. When your revenue does not pass it, you don't reach a GCT threshold. Hmm? Yes, even if it passed 5 years. For small companies, yes. All right. So now, example, tax loss 400,000. Again, the tax loss not recognized by the tax authority. So 400,000 versus 0. So there's a difference of 400,000. So you end up with a DT asset, 25% of the 400,000, 100,000. So although that line of 0 is not there, I want us to see the 0 line, because the 0 line just means that the tax authority not recognize it, right? So that's why. So you in your books you have 400,000, but according to the taxman is 0, so the difference is 400,000. Cool. And then 25% of the difference. And again, say it again, you only recognize the asset if you expect to recover it in the future, meaning you expect to make profits in the future. Other examples are there regarding revaluation of property. Another example is there. How is it presented and disclosed, and then some tips. Yeah, so y'all can read the rest, but that really is a little synopsis on deferred tax. One thing I want to go through is my computation. We're going to look at the schedules as well, but I want to go through now the Excel sheet I sent you, that blank template that I sent you. I want us to go through that a little bit. It is pretty much a guide, maybe one or two things missing, but I tried to make it as comprehensive as possible in terms for tax comp purposes. And you can utilize this. I'll just explain a little bit why all of these things, why you add, why you subtract. Okay, so let me switch my share screen now to this. No, that's not it. Is that it? No, not that. No. All right, let's go again. Here we go. Okay, so we have our profit before taxation. And then, as I said, I try to make it as comprehensive as possible. So when you're doing a tax comp, there are things you add back that are not allowed. Accounting depreciation is not allowed. The depreciation of a right-of-use asset, not allowed. Vacation provision, interest receivable, interest payable, we're going to see that. As I said before, accruals, this is not really allowed. Provisions not allowed. Loss and disposal, again, that's an accounting loss and disposal. Disallowed donations mean they're not approved charities. Fines and penalties, that's not allowed. You're the one who caused yourself to get fines and penalties. Disallowed entertainment expense or personal stuff. Other disallowed expense, we went through that list already. Unrealized foreign exchange loss. Now, I couldn't put a gain and a loss. I didn't really want to confuse everything, right? But they're going the opposite direction. Now, why I put the years? Assuming we are filing for 2024. That's why I named this template December 2024. What you're going to do, what you're going to realize is that any expenses that you accrue, so you notice the expenses for the current year, well, that depreciation is current year, right? True? You add that back. So, all right. So you add back depreciation because depreciation is an expense. I'm going to simplify it, right? There's a lot more. People speak a lot more technical with it, but I don't like to waste time with that. That's why I understand what you're doing. So the expenses, number one, depreciation is an expense. Agree? All right. So we add that back because they're not allowed that. So cool to the current year. Current year. So to the current year, yeah, they're not allowed that. Cool. So all right. Expense depreciation, so they're not allowed that. But I'm going to add it back. So these are the add backs. Now, depreciation and right of use, same thing. Depreciation, right? Provision for vacation, that's an expense, isn't it? So you make a provision, a payroll provision, also an expense for the current year again, right? So again, the current year expense, just like how depreciation is not allowed, the current year provision for vacation is not allowed as well. That's all. And this is another expense, right? Current year, 2024. Cool? That's an expense, that's all. All right. Another expense would basically be interest you need to pay, but you don't pay it yet. But you accrue it, type payable. You're not paying the interest yet, but you're supposed to say that's another current year expense. That's all. All right, interest, right? Payable though, but maybe have the words just to make it look like an expense, right? So the interest where you accrue, that's not allowed either, not true. And other disallowed expense, you have to add them up. Everything else below the line is disallowed, right? Cool. Everything else below the line disallowed. Another expense is a foreign exchange loss. Agreed? They say make a loss on foreign exchange. They must say, no, man, this is how you want your dollar to make FX loss. We don't know what rate you convert that. The FX loss, another current year expense, disallowed, right? So we see how all the current year expenses and the disallowed expenses are all disallowed. That's how you add them back. Cool? So in case you lost the template, you can do the template. That's the reason why I'm telling you this, right? So for current year, you add back all disallowed expenses. What are disallowed? Depreciation, accruals, provisions, and the regular disallowed, right? Those are, so you add back all of those current year expense. Good? Now there's something else in the line you see there that I ignore, right? The one that I ignore is what we call interest receivable. That's all. Right? Interest receivable. That would mean that that's an income. But so that has to go on the reverse. So all current year expenses that are not allowed are added back. Cool? So when it comes to the income, it has to be the prior year income that you add back. You got income working at the reverse. Right? So the only one, so all of these were all expenses. These are just for disallowed as well. So this cover all the expenses for current year you add back. True? But then when it comes to the income side, you're going to add back the prior year income. Follow? All right, so you add back the prior year income. And this is why the interest received, I'm not calling receivable because you know what, I can receive it now, that's true? Because the last year, so, right? So the prior year one is there. Cool. And then at the bottom piece is the reverse. That's how I'm going to tell you. And the bottom is the reverse. So all current year expenses are added back. Prior income is added back. Cool. And then what do you subtract? Is the prior year expenses that mirror these. So the vacation I accrued last year, you can subtract now because it's supposed to pay it now because it was the year before. People must have taken vacation already. Cool. So all of those other stuff where you can drop them in, right? The only thing, and this is why I said I didn't duplicate this because I think if you all understand how the FX loss work, what if it was an FX gain? How do we do the FX gain? Suppose I have an FX gain for 23 and 24.
You could only claim the 2023.
Go again, if I have an FX gain, yes, for 23 and 24, where do I put them? What I add and what I subtract?
You would claim the 23 because that is from the previous year.
23, right, so you'd add the 23, right? You'd add the 23, but right here, so you add the 24 and this, right? But you know what? Add the 23, and then down at the bottom, you subtract the 24. Lovely. And this is what I'm saying. That all you have to do is pay attention to the income and the expenses. Current year expenses. So I'm simplifying it, but you know, everything have its own explanation, right? But they're just trying to just stick one blanket. The current year expense, all you have to know everything that is allowed. So the first thing you know, all right, you know what my adjustments in the tax? My adjustments in my tax are depreciation and all type of depreciation, vacation leave provision, my interest expense, my interest receivable, any sort of accrual, any disallowed expense, any fine and penalties, the FX gain, we know that those are the lines we need to focus on, right? But then, okay, one up at the top, go at the bottom. All right, current year, one related to current year, the expense related to current year, go up at the top, right? The income that relate to prior year, go up at the top, right? And then the expenses that relate to prior year go down at the bottom, which is subtracted. And then the income related to current year down there, right? That's pretty much it. And then you have the number.
Can you repeat that, please?
Oh my Lord.
The up top, down, bottom.
Okay. All right. So as I said, at the top, all current year expenses, and this is very simple. This is being recorded. I shouldn't really record it like this because somebody will quote me and say, that's what we say at work. But it's the simplest way to look at it is this. The expenses that must be adjusted in your tax computation. That's the first thing I have to do. Identify what must be adjusted in your tax computation. Your tax computation adjustments include, right, depreciation, right, gain or loss on disposal, disallowed donations, fines and penalties, interest payable, interest receivable, vacation provision, on gains or losses, right? Those are, it includes those items. Once you know the items first. Now, what do you add at the top? What do you add to current year profit? What do you subtract? All current year expenses that are in that list, all current year expenses in that list are added to the current year profit. Cool? All prior year income, right, is added as well at the top. All prior year income is added at the top. Prior year. Cool? Now, down at the bottom, all prior year expenses are deducted and all current year income is also deducted, right? So that basically is it. So even though you have that template, you are going to understand just in case another line comes up that disallowed. As I said, I tried to make this as comprehensive as possible, But as I said, you do have an FX loss. Again, I mean, you have an FX gain for current year. So all right, that there. Correct. No. All current year prior income, income missing. You're right. That is correct.
And current year income.
Subtracted. Correct. Cool. Good to go. So y'all have it. Y'all, as long as you all can follow. And that's why I put some years beside those. And also additionally, your capital allowances now, you subtract your allowable loss, you reach a chargeable income, then you deal with employment tax credit. If you paid any estimated taxes throughout the year to see what the tax payable is. You had a loss and you had a loss no matter what up running forward, carrying it, how much you utilize, right? So this, I said, I try to make it as comprehensive, but just in case somebody said there's something else I missed, at least you can drop it somewhere, right? So how about just a general disallowed expense, entertainment expense, other disallowed expense, which probably everything else can drop in there. But just in case, at least you will know how to deal with those items. So yes, even though I didn't put the years beside those ones, I think you would understand that those would actually have to be current year. So the loss and disposal, the donation disallowed, the fines and penalty, the disallowed entertainment, the other disallowed expense, those would all be current year as well. I just didn't drop those in there, but those are still also current year. Okay.
Sir, 1 minute, please. For the total lease payments, is it just the principal payments or principal plus interest?
No, the total lease payment. It's going to be offset. Is the total lease payment, total payment, not the principal, the payments. Correct. The total payment.
Okay.
All right. So that said, the first one won't use this as much, but the second one will, because the first case. So there are two cases. Case one, I want y'all to do that now. Case two is going to use this even more with the whole current and prior. I wanted to do a little bit of. So case one is for y'all to do now. We'll go through it, we'll discuss it. And then case two, we'll do that case. But before case two, we're going to now go through some of the schedules. Even though all of these filings are online, I've sent you the paper version that shows you everything. So we can actually go through pretty much a little bit what goes through each line. So,
That will be for this year.
for the year, man. There's no there's look here, everything that have to do prior and everything that have to do prior year and stuff is dealt with already, right? So this has to be current. Yeah, so I want you to see I don't and put the year beside it, it has to do with the current year. Hmm?
So when you're doing the total income, isn't the expense for leases already included?
No, it depends on how people. No, it's right. I use it. It's a right. Use asset now. Yeah, remember, say it's not like rent. These are right assets that have to be recognized on your balance sheet. The lease you're talking about is like rent, not that type of lease. But we don't reach. But we're going to do the case. You're trying to master absolutely everything. Case. Yeah, man. But generally lease is capitalized, not expense.
So, but, you know, I was so confused with that.
The case is session 4 case study. The first case, let me tell you, what was it? Kingston something? Kingston Manufacturing. Kingston Manufacturing, yes. That is the first case.
So that's the one we're doing now, sir?
Yes. Go ahead and do that now, please. Yes. Kingston
Okay.
Manufacturing.
Even though I suppose
Go again. Mhm.
Sir,
Yes, yes, hold on. So hold on. All right, so you said for which one we're doing again? We are doing oh yeah, the first question. Yeah, I want all of us use the same rate. So just in case y'all have the wrong classification or category, um just open. Kingston Manufacturing. All right. Oh, I see what I had here. But the depreciation, all right. So in the case, you all have depreciation already calculated in the expense part, don't it? Right. So use that. So those rates are for the capital allowance. That's what happened. So use them as a capital allowance. They are not the income tax act rate. So some of them are off, but use that as the rate. I just use that. I don't want y'all to be split in between what is the right category, where compute is supposed to be, is this industrial building. I really don't want to get into that. So that's why I put those rates in the question. Just use those rates. So the rates that are
oh,
there, the depreciation is already there in total. So just use the rates that they say. I know you see the word depreciation, but use those rates just to ensure that we're all on the same page. Use those rates as a capital allowance for
capital
capital.
allowance. Okay, all
All
right.
right, because the depreciation, as we say, is already there, 6 million. That's already there. So for the factory equipment, just the 20% reducing balance, delivery, 25%, computer, 33 and a third, furniture 10. Just do that for now. We know say them a little bit different, but just use those. Because again, when you're using your template, you'll have them in the right category, you'll have the right rates to apply, but it's just a matter of application and getting the correct numbers.
So we
Once you
should
have the
use the depreciation rates as a capital allowance.
Yeah, man, it's really the capital
Okay.
allowance rate. The depreciation rate actually not there. Depreciation, even though the word is there, the depreciation rate's not there. You just
Okay,
have
okay.
6 million for depreciation, the rates aren't there. If you do that figure, you will not get $6 million. Correct. Yes, you will not get 6 million. So it's there for capital allowance. You know, say it on the top, right? Just slow the thing. Yes, a contract. So tell me how you normally treat contract. What do you think you normally treat it? We remember that, but I put it on my pop template, but as I tell you, I just take the template or remember. But glad me to tell you, say this on everything though. I am so happy I did say this was everything. Contractor levies, that's another thing that's added in the competition, but don't worry about the question. We'll get this question, right? So yes, there are more things that may be adjusted, but don't worry about the more things. Let's look at what I have now. Let's see if all of us can get this question right. All right, so this recording, y'all gonna see know that there's some level of silence because y'all doing the work. So that's about, well, yeah, that's about half an hour silence, but that's fine. At least whoever is doing it can actually try to do the case as well. So session 4, the case study, first case study. Now, let us get into Kingston manufacturing. Pretty much everybody's kind of on this. I can share my screen. I mean, whoever get it right, I guess I don't need to share my screen. But
Yeah.
I'm gonna share my screen. Before I share my screen though, would anybody like to share what they got? So I heard one student respond. Well, I look at a couple in the room. Anybody's confident enough to say, yeah, I feel this is the answer? No, man. Don't worry about the deferred tax. The income tax table is different, you know. The income tax table is separate from the deferred tax. When you book in the deferred tax, it's a journal entry, right? It's an accounting entry.
Not
Yes?
confident at all.
Not confident at all. Oh my. Yes.
I
Tell
got
me why you're confident.
1.4.
All right. So I just have a raw picture here. Yes, y'all use my template. Lovely. So in the raw heading, we have the $12 million. Cool. All the disallowed. So the entertainment, the income tax expense, and then put back there the fines and penalty, unapproved donations because it's not a registered charity. The disallowed expenses actually come to $2,950. The depreciation that you have to add back, we're going to less the capital allowance. And then that give you you adjusted taxable profit before loss relief 60,050,100. However, the loss relief has to be capped. It's 10 million loss you have brought forward, right? But it has to be capped. You can't pull the whole 10. Half of the 16 or 5,100 is 8025 or 50. Cool. So the taxable income is 8025 or 50, right? Because again, it's capped. Cool. So now the income tax on that is 2,062,62. However, let's work ETC. Payroll taxes paid was 4.5, but it is the lower of the amounts that were paid that are claimable versus 30% of the tax payable, right? The tax payable is 2,006,000. So 30% of that is 601,878.75. So that's what you can subtract from the income tax expense. So subtracting that, you would get, why did I highlight allowable ETC? Crazy. Is it 601 should be highlighted? But the math is right. The math is right. The math is right. So what is allowed is the 601. 601,875. So the final tax payable is a 2,062,62, subtracting the 601. So let me just put those lines in yellow so that we can see. So it's 2,006, subtracting the 601,878 to give you your final tax payable after ETC to be the 1,404,383.75. Below I have my loss memo to show how much losses I still have available to carry forward. So I have 1,974,950 that I can carry forward for 2025. Are we okay with all of these figures so far? Right. So we are okay with the figures, right? But go to the figures. Even if you didn't get it, I hope you followed, right? Now, for the capital allowances, we all did our capital allowances, so I think that's fine. 4,899,900. The issue that I heard y'all having was with the deferred tax. As they said, the accelerated capital allowances would arrive, let us arrive at a deferred tax liability, right? So the accelerated capital allowance.
Sorry, go back to your capital allowance. I think I'm missing something from.
Okay, what's that? See that?
I think my 33. I think my 33%. I round it off.
Yeah.
So maybe because I have 4.9.
Yeah, man, that's fine. Don't worry about the $100. That's fine. That's fine. It's okay.
Okay.
Yeah, man. That's more accurate. The $100 is more accurate. Yes, that's fine. All right. All right. I know for the deferred tax. So the accelerated capital allowances would result in a deferred tax liability, right? Because of course that's more. So that would result in a liability. Now the accrued bonus, as we say, is a provision. That's all. Normally provisions are not allowed and they normally result in assets. That's just a general thing. So provisions, accruals are normally not allowed. The taxman don't recognize them. They only recognize things when they are received or paid, right? So this accrued bonus, they don't consider it allowable. So that whole 1.2 million is going to end up being a deferred tax asset, right? So that's pretty much. So when we look at provisions, so just to make it simple, provisions and accruals are not recognized by tax authorities. They recognize them when they are paid, right? So generally, provisions and accruals automatically arise with a deferred tax asset. But as we say, we can only recognize that we expect to make future profits. But normally, those automatically give you deferred tax asset. Cool? So, yeah, any kind. They're all expenses. All provisions are pretty much expenses, in essence. I expense them and they credit them up top. Yeah. So any kind of provision, they normally don't recognize it. Okay? So, that said, before I even start going to the forms, let's go to the next case. And then we can, when we have everything, now we can talk about the forms. Let's do the next case. Now, the next case have the interest received and the payable and all of those stuff current year, prior year. So the next case has it. So let's do case number 2, which is Montego Textiles. So you have your profit, capital allowances working, and asset was actually disposed of. Other adjustments for interest received and vacation accrual. We could have put in more. We could have put in the foreign exchange gain and loss, but just want to put in 2 so we can see how those 2 work, right? We still have brought forward losses to work with, and we have some disallowed expenses. We have our deferred tax and to do our ETC. So yes, maybe not everything in the question, but I add a little more so that we can apply what we just learned. Stacy, yes, you have a question. Sorry, I just actually seen your hand was raised. Still have the question or it went gone already? Very good.
I'm sorry, I still have the question.
Okay,
You
go
were
ahead.
breaking up and I didn't hear exactly what happened to the deferred tax for the 700.
Go again. You didn't hear what happened to it?
Yeah, how do we treat it?
Yeah, you debit the income tax expense and you credit the deferred tax liability. That's it. So you're
So
going to
that
debit
means
the
it has,
income tax expense and you're going to credit the deferred tax liability.
okay.
Yeah, that's it, man. That's the treatment. That's it. That's a net deferred tax liability. So you're going to just debit the deferred tax. You're going to debit the income tax expense, and then you're going to credit the deferred tax liability with the
So I
700,000.
have another question. When you're doing income tax calculation, the tax charge in your P&L is a combination of the provision, like the 25% of your profit, plus deferred tax.
Correct.
Okay, what portion of that is paid over to, or what part of that is paid over to the tax authority at the end of the
The
day?
same portion that we have in our tax comp. Remember, deferred tax have nothing payable or not until these things are sold. So what is payable is in the tax computation. You see, I have my deferred tax separate from my tax comp. What is payable is what we have as payable. So you see, I had final tax payable in yellow. That's what is payable. The deferred tax is not on the sheet at all.
Okay. All right,
Yeah.
thank
So
you.
yeah, no problem.
Can you please scroll on to the bottom a little, please, of the tax computation sheet? What you had on the
Okay,
bottom?
you mean with the loss memo? The loss memo. So it's just to show how much of the losses were claimed and which year it was claimed, since it's 1 year. But normally it have multiple years. If it's a lot of money and you're just trying to show how much was claimed. So what I can claim in 2025, what remains is 1,974,950. That's it. Maximum I can claim from the losses from 24. Okay, this losses was being brought from 23, but in 24 I claimed some. So what remained carry forward is 1,974,950. Okay.
So we're supposed
So
to
it's
move on
time
to
for
the
the
next
second
case
case.
today?
Next case. Go ahead. Next case. Yes, yes, everybody. Next case. So it tell you the proceeds, but did it tell you what was the book value? What was the net book value in the financial statements?
This has nothing to do with profit or loss.
No,
This has-
that's a balancing allowance because they didn't give us what what the net book value was in the financial statements.
Let's give it a cost.
All right, people. So let's do what we need to do. So we say our accounting profit is $13 million. Good. What's your accounting depreciation? 8.5, right? We know we need to add that back, right? Cool. We also know we need to add back the disallowed expenses, which is what? 3,850,000, something like that. That's the disallowed one, right? And then we have to do the adjustments for the interest receivable and the vacation, also. Okay. And we know the years, the current year and the prior year. So the interest receivable, the vacation accrual. Yeah? When we do those, yes, when we do those adjustments, what do we get? What kind of figures we work to before reaching the capital allowance line?
For the decrease in the vacation accrual, I have minus I have the 500,000.
Mm-hmm.
And the interest receivable 600, but we're gonna less the vacation accrual from the
Okay.
others.
Okay. All right. And we end up with what as our adjustment even before the capital allowance? So what was the figure?
Pardon me?
What's the figure we have before the capital allowance adjustment? So she said 24,250. What anybody else have another figure? Is the same figure everybody have? Before the capital allowance adjustment. They look like that's a confident today. 25,750. Take it out, Mike. Yeah. Yeah. They didn't give us a new value.
25,450 I have, sir. 25,450.
25,450. That me have. That's why I'm listening out. That's why I'm listening out. So I'm trying to figure out what figure do we have off. Come again. List it again. 13 million. Accounting depreciation 8.5.
I think because I put the 600, then let's say 600, the change in the interest receivable.
Oh, the top and the bottom. So you have the disallowed being the 3,850 overall. All of those come to that. All of them come to 3,850.
What about?
But I get the 24,250 too.
The interest receivable. What did we have
The
for the interest
donation,
receivable?
sir,
Yes.
because you said 3,850, they're wondering what you're talking. So the 3,850,000 would be the donation and approve the traffic fines, the personal travel, and
Yes.
the income tax expense. That's what I think they're
That's
asking what
yes.
you're talking about.
Correct. And then now hold on. So then now we have the interest as we said. All right, interest receivable.
For
Right?
600,000.
That it's an increase of
Yes.
600,000. It's an increase.
And
So
the
there were
accounting
two things, right?
depreciation
But
of
that's why
8.5.
right.
So
So
if
that's
it
why I'm
increases-
saying that I'm asking you all after all those. So we should have the same figures because all right, so it's an increase. So we know the closing interest receivable, the opening interest receivable. So we get it, the 400,000 to 1 million. And so when you put them where they're supposed to be, right? Cool. Because the one that says opening 2024 mean that was 2023 figure, right? Okay. So right. So you did what? Okay.
Come to the vacation.
The vacation as well, we know says that it's
a
500,000 difference,
decrease.
but yeah. So the
So
I
vacation
understand
reduced.
the vacation, but I'm not
2023
understanding the receivable, the interest receivable
Alright.
part.
All right, the
Are
vacation
you
that they
using the
came for
template? Do you have the
500.
template? Hold
good
on,
with
hold
the
on. Are you all using
vacation.
the template? Hold on a second. Are you using the template?
Yes, I'm using
Yes.
the template.
And the column that says opening, we know that's 2023. And we
Yes,
are
it is the
putting the things in
400.
where they're supposed to be, where it has 2023, 2024. We are doing that? So I'm trying to understand what's the not understanding because it's a placement thing, you know. I can explain again why they go up at the top and the bottom, but it's a placement right now. So that's what I'm trying to figure out.
There's a difference between both the opening and the closing, so 500.
So up top, are we supposed to have negative 500 for the provision for vacation because it went down, or it's supposed to be at the
No,
bottom?
down the bottom.
Okay,
No,
okay.
no, all right. Yeah, you can put the both lines though. Remember the provision, remember you can put both lines. So that's why I'm trying to understand why
So,
we are throwing
sir,
off.
Be-
I already
because
in
I
the
have the
template I gave everybody, it has provision for vacation 2024 at the top, and it has
which would have
provision for
been the 1
vacation
million,
2023 at the bottom.
and that would be 1.5.
And then the difference between both would be the 500,000.
Oh yes, 24 2. Let me put them in the template. I have it. All right, good. Let me bring up my
In
screen.
my template, I
I
still
see why
getting the
there is a
24,250.
difference here. So it's 24,250 using the template
Yeah,
and not the 25. Okay, fine.
no.
So these are the figures. Everybody seen the figures now? All right, I merged the 3,850 by the way. So please pardon me. I just put all of them as 3,850. But all the other figures we have going, all the other figures we have flowing,
Yeah.
everybody seen the figures now?
I'm looking. Oh, okay, okay.
Good?
Here.
So that's where we are now, all right? No, but you're not the same figures. You probably don't pick up at 200,000. I'm not sure. All right, we're gonna have to move up though, because we should have the same figures. So the capital allowance, the annual allowance, 6 million, the balancing allowance, and the asset that was sold is 1.5. Because as we said, the written down value was 2 million, and how much it was sold for is 500,000. So the balancing allowance is 1.5.
5.
Give us 7.5.
So,
Right?
sir, even though it was sold in June, you have recognized the entire annual allowance?
Yes, man. Yes. Full. Yes. Full amount. It's not depreciation you're prorating it. You sell it. That's what it's worth. Remember, they said this is accumulated capital allowances, right? Yeah. Okay. Right. So yeah. So the government said only worth it worth 2 million. They sell it for 500,000. So that's why the 1.5 is an allowance. I mean, it's a loss on disposal the government allows, because they are saying it actually was worth 2 million and you did lose 1.5. So we're going to say yes, please subtract it from your profit because you did lose it. Okay. Unfortunately, this question I didn't have a loss on disposal. To get that, now you'd have to add back the loss on disposal. Our loss on disposal arrives is based on what you have as your net book value versus what you sell it for. Right? Not the capital allowance schedule, but your fixed asset register. Now, in terms of the allowable loss, again, it is, how much was the loss again? 8 million. Okay, so this, I need to change
Yes,
this.
the loss was 8 million.
8 million was the loss, okay?
Mm-hmm.
So you can recognize everything because you have enough profit to deal with. So the chargeable income, 8,750. Income tax, 25% of that. The
Sorry,
base
you
on
lost
each,
me.
where?
Because
Where?
I am, you're 24, 250. I have 24, 450. I don't know what the difference.
No, I really can't. I don't know what the difference is. Because if you're looking at my screen and we have all the same figures, depreciation, provision, 1,400,000 at the top. All the disallowed should be
I
3,850.
have that.
Could you repeat for me how you got the what's it called again? The capital allowance, the 1.5, or I only have 6.
The 1.5, because the asset you sold, you paid 4 million for it.
Mm-hmm.
The capital allowance to date on it was 2 million. So 4 minus 2 means that it's not worth the written down value, which the tax written down value is $2 million. You sold it for 500,000. So you sold it for 1.5 million less than what the government says it's worth. So you made a
Okay.
loss on disposal, which is known as a balancing allowance.
Okay.
So how
So
you
that's
get
the 1.5.
26 million? Because I'm not, my adding not giving me 26 million. That's the problem.
No, well, it's a calculator. 13 plus 13 is 26. 8.5, 9.5, 9.9. Let me just highlight this here. 13,750. Yes. 13,750 plus 13, 26,750. All right, just check the
450,
formulas, man.
107.
Just check your formulas, because I just checked mine. So now we are the income tax is 25% of the 8,750, which is 218,750. Now, ETC, we're gonna have to determine, okay, what we're gonna use. We're gonna have to use the maximum, because how much did they pay in terms of statutories? 6 million,
6
right?
million.
You only have 2 million working with, so it have to be the maximum 30% of the tax payable. So 30% of the 2187, then you get 1531. They didn't pay any estimated taxes. If they did, you subtract it, and then you would get your tax payable. This loss here, I should just put, they use the full loss. There was 8 million and they utilize the full 8. Yeah? 250. Yeah, man, that's what I have. Yeah, good to go. All right, so other than your formula issues, you're good to go with this? Because I don't see why I would have the same figure but different numbers. So I think it's probably a little formula issue. All right, for the deferred tax, I'm gonna move from the screen a second because we need to look at the deferred tax as well. So let me just go back to what was my other, is it this? Deferred tax, accelerated capital allowances, 6 million. So that, of course, a deferred tax liability, 25% of that, 1.5. The vacation is a provision, right? It's an accrual, a provision. So it's a deferred tax asset. So 25% of the 1,250,000 end up with a net deferred tax liability of 1,250,000. Again, for deferred tax liability, debit income tax expense, credit the deferred tax liability.
I get that, sir. And your capital allowance?
Yeah?
The capital allowance?
Yeah, hold on. Yeah, you see it? You see my screen? Right. Oh, that's why you said I moved too fast. Because I'm speaking from the script. Right. So the accelerated capital allowance is of 6 million. It's going to result in a deferred tax liability. 25% of the 6 million gives us 1.5, which is a DT liability. They also gave us a vacation pay accrual. Remember what I said about provisions. Provisions or slash accruals generally result in deferred tax asset. Why? The government doesn't recognize these things because they say they only recognize expenses that are paid in the period. So when you provide for some or you accrue some, they say no, zero, right? So that generally results in a deferred tax asset. So that 1 million that you accrued for vacation will result in an asset of 25% of that figure, which is 250. So you have a deferred tax liability of 1.5, a deferred tax asset of 250,000, which nets out to a deferred tax liability of 1,250,000. And all you have to do is account for this deferred tax liability. It's not going to go in your tax computation, but in accounting for it, you're going to do a journal where you debit income tax expense and credit deferred tax liability. Cool? That's the accounting for that. The capital allowance, everybody got the 6 million, the asset that was disposed of. As we said, the original cost was 4 million. The accumulated capital allowances was 2 million. So the written down value, or let me put a T, the tax written down value, which what the taxman recognized, is 2 million. So you sold it for 500,000. So you have a balancing allowance of 1.5, right? So you have a balancing allowance of 1.5 million.
So, sir, that wouldn't go on the capital allowance. That's separate.
It did, yes, we did have it, man. We have it. Remember, put it as another line. So we have initial allowance, annual allowance, and balancing allowance. That's what we had in the tax pump, right? And if you merge it as one line, okay. If you put it as one line, that's fine as well. No, what? No, loss on disposal is accounting loss on disposal. There's nothing we put in that line. That only comes into play when you're comparing your net book value and your sales proceeds, right? We didn't get that. I didn't give you all the net book value of the asset. I just told you what capital allowances were taken out of it on the capital allowance schedule, right? So that's what I did, right? I'll fix this up after. Yeah, don't worry. I'll fix up my stuff down there. Change of that. Okay, those are the numbers. Yes, Stacey, go ahead.
Why was the interest receivable not part of the deferred tax calculation?
There are a lot of lines to go in the deferred tax calculation. Generally, is almost the entire balance sheet. We're only doing 2 lines for the deferred tax. You have an appreciation of the deferred tax. Okay, that's why that's always in the workings. Yes, so there are. So highlighting that a lot of the lines within the balance sheet are going to be impacted with deferred tax, but I only selected 2 lines. So we have an appreciation of just a provision and an asset, just an asset and a liability. Yeah, but for the deferred tax calculation is pretty much the balance sheet. You're really going to put everything regarding the carrying value and the tax base. So
Okay.
that's a good thing to note. So everybody to know the deferred tax is just to give you an appreciation.
All of
And
the
that's what we have in this, that's what I have in terms of just to give you an appreciation. But
the fixed
generally,
assets on the balance sheet.
yeah, man, as I said, pretty much almost every line on the balance sheet, you're gonna be comparing the tax base and the carrying value, not just the fixed asset. Not just a fixed asset, current assets, current liability. So you're gonna be comparing those, yes. The carrying value versus the tax base.
Okay, to get the temporary difference and the times that by the tax
There you
rate.
go. Correct.
Okay.
That is correct. But all we're doing now is just an appreciation of it. So we just use the asset and a liability just to appreciate the deferred tax computation. All right, so just one quick overview before we end. Second. And that overview will be.
Sorry, we share the answer, but there's still more.
Yeah, man, they always share. Yeah, man, we share. Always share, man. So let me see. Where is that for? Schedule. Okay, so very quickly, this is too large. I mean, too small, I mean. Move this out, share screen. Okay, so as I said, these filings are all online. You're usually not going to be using forms like these. Really just to know what type of information is needed when you are filling out, when you're doing your filings, right? So the information that is needed, company information, TRN, address, whether or not it's the first time that the company is filing, what type of industry you're in, and then now the other details, your income, cost of sales, business administration expenses. But then, of course, some of these you're going to say there, you're going to have a schedule that you fill out depending on the size of the company. Now, the instructions, why I show you this is that these forms usually have detailed instructions at the back, right? So it gives you an idea as to what are the things that are needed and what you need to fill out in terms of the form. For the tax itself, you're not going to fill out the actual taxation, but at least you have an idea when you're filling out these forms if it's going to work back to the tax that is assessed for you. So questions are asked about contractor levy, so those are there. Corporate tax credit, that's automatic. The ETC, you'll have to fill out what I call a Schedule 7, which is actually in the online format. So you can use these forms to look and see what information is necessary. That's the reason why I send these forms. But these forms are no longer used. So you're not going to say you're going to fill it out and go at the tax office and drop it off. No, you need a portal. You have to do online filing. So these were just shared for you to know, okay, this is the information I need. So when you're about to file, at least you'll know all the information that you need to include. So director's information, their TRN, etc. That you need to have that information. Some other things that will be going with it, your Schedule 7, your capital allowance calculation. Also, your Schedule 1, your trade, is looking at the trading income, etc. So those are forms. All of those forms I sent to you. But again, these forms are not physical forms that will be used. It's just to give you an idea how it will look. What type of information you're going, when you go on the portal, what type of information you have, and what you're going to need to fill out. So for capital allowance, you need to know the date of purchase, date of acquisition of the assets, the list of your assets. So these are things that information that you must know before filing. So I wonder if I know Stacey hand raised. I believe Stacey asked already. I just didn't lower her hand. So yes, so that's the reason why the forms are there, and that's why I said it's just a quick share. The forms are just to give you an appreciation of the information that is needed when you log in to do your filings. Our next session, we're going to focus on individual. So the information here generally that we have is to file the ITO2, the ITO7, which is companies, right? Now we're going to be looking at individuals filing the SO4 and the SO4A. The difference with that is you have individuals who have their own businesses. So you have an individual who have a shop, or they are a mechanic or whatever it is, and they're also employed. So you need to be looking. We're going to be seeing P24, P45, and then actually they're trading. And how do we put all of that on their SO4 for? So that's really what we're going to focus on in our session on Monday. So again, no assignment today is really to go through the forms, have an appreciation of the forms, and then we will look at the individuals in our fifth session. And the last session, we're going to focus mainly on payroll and a few other little things. So we're going to focus on payroll, the SO1, the SO2, and a few other little things in the final session. But Monday is individuals and partnerships, SO4, SO4A, and some of the schedules pretty much are the same schedules that also go with the organizations as well. If you don't have any questions, then we are good to go. I will share the solutions as is customary and share the recording as well. So I'll share the recording and the solution. This recording, we realize I gave you time, so you're going to have some long gaps in between, which are the time you all are using to work the question. So the recording will be shared, the solution, and then of course, before our session, we will get our notes to session 5.
So Monday is the last class, sir?
No, Thursday. So Monday we're
Okay.
doing individuals, and then Thursday will be the final class where we look at payroll filings.
Okay.
All right, so take care.
All right, thank you.